Good morning, everyone. Welcome to our weekly research morning call. For today, we have initiation on Del Monte Pacific, updates on CapitaLand Integrated Commercial Trust, Keppel Corp, IX Biopharma, and our usual Singapore weekly. So I will be starting off with the initiation on Del Monte Pacific Limited, or known as DMPL, in our report titled Turnaround Underway. So to start off with a brief company background, Del Monte is a global branded F&B company and a leader in canned fruit and vegetables. So other than canned fruit and vegetables, they also sell sauces and also beverages like juices and fresh, frozen and packaged pineapples. They hold leading positions in canned foods in the US, and they also have dominant market shares in the Philippines, which we will have more graphs on this later. Referring to the chart at the top right, this shows the main subsidiaries that they have. So the main contributors of the revenue from the left are Del Monte Foods, or DMFI, which is the US subsidiary, contributing about 69% of the revenue. So this is in line with, if you refer to the chart, revenue by geography segmentation. America's region contributed around also 69% to the total revenue for FY21. The second subsidiary is Del Monte Philippines, or DMPI, which is primarily present in the Philippines and also other Asian markets. This is the most profitable subsidiary. Other than that, they also have SMW and a few other joint ventures. The pictures at the bottom are a few examples of the products that they sell under the Del Monte brand. So you have the traditional canned foods like your canned beans, canned tomatoes, culinary products like the spaghetti sauces, and also beverages like fruit juices. So moving on to the first investment merit. Next slide, please. Yeah, firstly, we are seeing a turnaround of the US subsidiary, Del Monte Foods, or DMFI. In FY21, DMFI reported a net profit of $15.8 million US. If you refer to the net profit and loss chart, you can see that over the years from FY16, they were incurring losses since FY16, and the losses increased in FY18 due to the fact that they closed 3 plants and another 4 plants in FY20. So they booked one-off expenses due to that. On the path to profitability, other than closing factories that were loss-making or contributed to excess supply, they also exited low-margin products, including those of private labels, introduced new and innovative products catering to changing consumer preferences, penetrated various distribution channels, for example, the fresh section at Walmart, and also raised prices, especially in 2021, in line with the US Consumer Price Index that increased for canned vegetables around 4% year on year. So the pandemic has also caused consumers to do more meal preparation at home, and they are turning to trusted brand names like Del Monte for these options and also healthier snacks. Del Monte Foods has introduced more of options, as mentioned, catering to changing consumer preferences like those pictures at the bottom, the Joy Bar bubble tea, and healthy snacks like the Veggieful pocket pies, which have plant-based proteins. New products like this, introduced over the past 3 years, contributed to around 6% of FY21 revenue, and this is quite a substantial figure considering that total revenue is about 2 billion. So 6% would be around 120 million from these new products. The chart on the bottom right shows the market shares that Del Monte Foods has in the US. So they are among the top 3 for canned foods, number 1 for canned vegetable, number 2 for canned fruits, and so on. And with a strong brand, this gives them the ability to raise prices, which, as mentioned, they have done a few times over 2021, in line with the rising US CPI on canned foods. Moving on to the next investment merit is the dominant market shares in the Philippines of up to 90%. They are expected to continue driving the sales. So Del Monte Philippines, or DMPI, is the most profitable subsidiary and generated a record net profit of $94.5 million US, and this is up 40% year on year. So referring to the chart on the top right, you can see that they have about 90% market share in packaged pineapples, 77% in canned mixed fruit, 50% in ready-to-drink juices, and so on. And the pictures at the bottom are some examples of the main products sold in the Philippines under the Del Monte brand, including culinary products like green curry mix, beverages like fruit juices, and they also have fresh pineapples sold under the S&W brand. This is one of the highest margin products. The other thing for DMPI is that they have entered into the dairy sector through a joint venture with Vinamilk, which is Vietnam's largest dairy manufacturer. So under this joint venture, they would import dairy products under 4 product lines and distribute them in the Philippines, including flavored yogurt drinks, milk tea, fresh and flavored milk. And the picture at the bottom right is an example of the flavored yogurt drink. So with the wide distribution network that Del Monte Philippines has in the Philippines, that their products are present in more than 100,000 stores, they could quickly scale up the distribution of these products. Moving on to the last investment merit is the significant undervaluation of DMPL, Del Monte Pacific Limited. So the stock is currently trading at about 8.2 times FY22 PE, according to our estimates for FY22. And if you refer to the column highlighted in the red box, this is far below the consumer staples industry average of about 16 times. So DMPL had been underperforming after the acquisition of the US subsidiary, DMFI, in 2014. But over the years, they brought in a new management team, which managed to turn the US subsidiary around successfully, steering towards the direction of innovation, introduced various new products, and also expanded the distribution into key growth areas. Another possible reason for the undervaluation could be the high debt level. So they have a net debt of around 1.3 billion US dollars. And you can also see this from the gearing level of about 200%, which is higher than the industry average. However, we expect that to wind down gradually with higher cash levels and also possible repayment of some short-term borrowings. Lastly, stock catalysts include the turnaround of the US subsidiary, Del Monte Foods, and also dominant market shares in the Philippines that could continue driving the sales. That leads us to our valuation. So we initiate with a buy call and a target price of 60 cents. This target price is pegged to 13 times FY22 PE as we take a 20% discount to the industry average, taking into consideration the high gearing level and also smaller market cap as compared to their peers. So that's all for Del Monte. I'll now be passing the time on to Natalie for CICT.
Thank you, Vivian. Good morning, everyone. So today I'll be talking about CapitaLand Integrated Commercial Trust, CICT's third quarter business update. Overall containment measures are slowing recovery. Next slide, please. First off, starting off with the table on the left-hand side, we see that gross revenue and NPI actually grew by about 119%, 132% year on year. However, do note that this is because CICT, the merger of CMT and CCT, was completed on the 21st of October 2020, and as such, the 3Q20 data is actually for the pre-merged entity being CMT only. Okay. Overall, the thing to note here is that there's a lower rental relief burden for CICT in FY21. CMT paid out about 108 million in out-of-pocket rental relief in the first 9 months of 2020 versus 21 million for the first 9 months of this year. Another thing to note operationally is that tenant sales for the first 9 months of 2021 is currently now at 83.8% of 2019 levels. It has sort of declined slightly compared to what it was for the 9 months ended 2020. And this is because, if you remember, the first quarter of 2020 enjoyed a full quarter of normalized trading compared to 3 COVID impacted quarters in 2021. Okay, in terms of the positives, we see that tenant sentiment is recovering. The first 9 months of 2021, rental reversions have improved from -8% to negative 8% from -9.6% as at 6 months 2021. So it's a bit of a narrow. The leases signed in the third quarter have been at lower rental reversions, bringing up the average reversions. Positive reversions have also been signed for some of the suburban leases, and in terms of the leases signed in the third quarter, there has been 65.5% of it is actually from tenants who are new to the market or new to CICT's portfolio, and expansions accounted for 34.5% of the leases signed. So of course, that also points towards an improving tenant sentiment. On the office side, office leasing also grew 1.3 times quarter on quarter. Yeah, and for the third quarter, there was an increase in the number of tenants actually looking to expand, forming about 38% of the demand. Okay, now moving on to the negatives. The negatives are largely related to the current COVID-19 situation in Singapore and the restrictions. So the tightened restrictions dampened leasing and has depressed occupancy very, very slightly. The 2-pax group limit has actually curtailed physical visits, physical viewings of space. This also has prevented some leasing. Retail and office occupancy have dipped very, very slightly. Less than 1%. Okay, and also for the 9-month ended tenant sales, it dipped versus what it was for the six months ended 2021. In terms of outlook, first of all, of course, the positive would be the lower rental reversions in FY21. The management is estimating 30 million worth of rental reversions, equivalent to about 0.5 months of rental reversions in FY21, and this compares to 128 million that was actually given out to tenants in the full year of FY20. There's also the repositioning of Raffles City and Clarke Quay to look forward to. So these two assets have actually been more impacted during the COVID period. At Raffles City, we saw the exit of Robinson, which occupies level 1, 2, and 3 of a selected portion in Raffles City, as well as in Clarke Quay, where we know that that there's a lot of nightlife as well as entertainment related trades that have they're still under a lot of restrictions. So this has affected the occupancy in both of these malls. Occupancy for Raffles City is currently about 91.5% versus Clarke Quay, which is about 79%. Yeah. So the repositioning of these malls, the elevating of the trade mix and recalibration of the trade mix, hopefully this will help to improve the leasing and occupancy at these malls. Okay, we are also expecting a bit of an uplift from the relaxation of safe management measures, and this of course hopefully will lead to better tenant sales and car park income. Overall, we maintain our accumulate and target price of $2.54. Our FY21 and 22 DPU yield of 4.8 and 5.6%. So for our DPU yield for this year, we have actually factored in 1 month of rental rebates, as to be on the prudent side, and of course this 1 month is more than what the management has estimated, being 0.5 months only. Yeah, so we're erring on the side of caution with regards to our earnings forecast. So that's all for me. I'll now pass the time on to Terence.
Thanks, Natalie. And good morning, everyone. The title of our latest report on Keppel Corp is On Track to Exceed $3 to $5 billion divestment target by 2023. And this is because of the 2 recent announcements that the group made, inching them closer to their target divestment. In our next slide, Keppel announced that it has reached a settlement agreement with CICT Brazil, the Brazilian company, relating to its frozen rig jobs, which is now effective. There will be no penalties or refunds due to any party. Keppel Offshore and Marine, or Keppel O&M, as the subsidiary of Keppel, will have full title and ownership to the 4 rigs. So to recall, Keppel had received $1.3 billion or 1.7 billion Sing dollars in progress payments from CICT Brazil for the rig orders, the stranded rig orders which they could not complete. This had a total contract value of about $4.9 billion before payments stopped in November 2014. So when payments stopped in November 2014, the group also proceeded to stop work on the rigs in 2015, in January 2015. What that happened is that the rigs had varying levels of completion levels, or about 20% completion. So the positive that we see from this latest announcement is that Keppel O&M is now free to explore various options to extract the best value from the 4 remaining rigs. It is favorable also as it simplifies the process of selling its legacy rigs and associated receivables to a separate asset co. You may recall that the launch of Asset Co was established under the non-binding MOU signed in June this year with Kyanite Investment Holdings, a wholly owned subsidiary of Temasek. So so if you look at this image here at the bottom, you can see one of the things that they also signed in June this year was the exploration of the Keppel O&M's merger with Sembcorp Marine. So this is currently under review, and this process would see we view the latest signing as beneficial to the process of simplifying the merger of these 2 entities, and also for Temasek to link the entities up as well. In our next slide, M1, a subsidiary of Keppel, and Keppel DC REIT have signed agreements for a proposed investment by Keppel DC REIT into M1's Network Private Limited on NetCo. NetCo will own M1's network assets in mobile and in TV as well. The proposed investment is expected to be DPU accretive to Keppel DC REIT. When completed, M1 will receive a cash consideration of approximately $580 million, or the net book value of the network assets. So we view this move between M1 and Keppel DC REIT as another positive for Keppel to hit the higher bound or exceed the target, the $3 to $5 billion divestment target. Since the announcement of the monetization, the $3 to $5 billion monetization target, Keppel has already announced monetization of over $2.3 billion from October 2020 to July 2021. So you can see they're almost approaching the lower bound of their target, and based on the guidance from management, they can easily hit the top bound, which we believe will come before 2023, and maybe even exceed this as well. Of the $2.3 billion of monetization already announced, they have already completed half. But the transaction between Keppel and Keppel DC REIT is still subjected to approvals. M1 is not expected to recognize any gains from this transaction because the sale is done based on the net book value. We expect Keppel to recycle the capital to help M1 invest in new capabilities and also fund other growth initiatives like the Bifrost cable system, which is expected to commence building in the first quarter of 2022. In terms of outlook for Keppel, in our next slide. Yeah, thanks. In terms of the outlook, the EGM for the proposed acquisition of SPH is expected in the mid of November. If approved, Keppel will acquire SPH X, the media business, and this and Keppel have already announced plans to start to monetize some of these assets from SPH. So we see the acquisition of SPH as being positive for the group. Another catalyst for the group is the potential combination of Keppel O&M and Sembcorp Marine, which we expect a potential announcement in the fourth quarter of 2021. So this is coming in the next few months. We expect the divestment of Keppel O&M to be positive for the group in terms of the re-rating of the group because of the disposal of one of the business units that had the most drag on the whole entire operations. So in terms of our recommendation, we maintain our buy recommendation with a higher sum of the parts target price of $7.07 from $6.28 previously. You'll notice that the $7.07 is much higher now because one of the reasons is because we incorporated Keppel Capital into our model now, as it has gained in significance to warrant a value assigned to it. We now reflect, in terms of our valuations of Keppel, we now reflect it based on the 4 new segments to better reflect its reporting segments going forward. So if you look here at the table on your left-hand side, you can see that our valuation of Keppel is now based on these new segments, not the old one previously. And there are 4 segments are energy and environment, and under energy and environment, you have Keppel O&M and Keppel Infrastructure Holdings. Under urban development, you have CapitaLand and Sino Singapore Tianjin Eco-City, and M1 under connectivity. And under the asset management business, we have Keppel Capital newly added and the other listed entities within the group to derive a fair value target price of $7.07. So that's all from me for Keppel. I'll now hand over the time to Paul.
Okay, thanks. Let me just take control of the remote control. Okay, so thanks. So we recently issued an update on IX Biopharma. I mean, we think there are at least 4 share price catalysts for this stock. Okay, try to, yeah, sorry, let me just try to change slide. Okay, yep. Oh, so sorry, because it's not easy to control. Okay, because I'm having control of the mouse now. Okay, so thanks, sorry for that. So in terms of the catalyst, so let me just run through with you in detail. So the first catalyst is Biopharm out licensing. So what we mean is that with this product, this drug here, it is a drug to treat pain using ketamine. And if you can actually, if you treat pain, and then if you can, the bigger market is actually even depression, but I think you treat pain is really good enough, and they are virtually trying to substitute what is being used, which is the opioids market. So the difference for this product, just as a reminder, is that it will be delivered sublingually through IX Waferix technology. Sublingually, basically means just be placed under the tongue for faster absorption into the drug, rather than, if you swallow, you have to go through your digestional tract and so forth. So for this product, it has completed the US FDA phase 2 trials, but the next phase is to license the drug for phase 3 trials and commercialization. So basically, they have to find another much larger, of course, pharmaceutical company, a licensee that will take on this phase 3 trials and also to commercialize it. So if this happens, they will get like 4 types of revenue, or virtually income, because there's virtually no cost, right? So you get an upfront payment, and then you receive milestone payments from the licensees if you complete the phase 3 trials. And then once you start selling and you hit revenue targets, you also get some sales milestone. And the big one is you will get royalties. For every dollar sold, you get a certain amount of royalties. So this will be the biggest catalyst. They started the process, I think as per the report, in March of 2020, but these things takes time, and it will also be a bit delayed because of the pandemic and so forth. Out of interest, I mean, if you do want to read like how they do these trials, which are actually pain trials. So those who undergo operation, then they actually interview them what's their pain level. But if you want more, you can go to our Ground View magazine, which is in our Stocks B&B website under the sector reports. So this is the first catalyst. This is the product, the Biopharm licensing deal. The second catalyst is a Hong Kong IPO. So there are plans to list their pharmaceutical business on Hong Kong Stock Exchange. As a biological company, it's under this thing called Chapter 18A for biotech companies. If they do this, the positives will be, number one, you raise money. Number two, there is some price discovery. Because to list here, you need a minimum market cap of 260 million. Their market cap now is 170. So this is higher than the current market cap. To get these valuations, you need like pre-IPO investors to come in to give you this kind of valuations, or anyone to kind of underwrite to get these valuations. Otherwise, this is the minimum that you get. So if this happens, then it will be another catalyst for the stock. The next catalyst is wafer seal registration in China. So wafer seal is basically a Viagra kind of product because it's for male erectile dysfunction. It uses the active ingredient found in Viagra. So once Viagra goes off patent, or you use the active ingredient. So the key thing is, can they get it registered in China. So they're working with this the Chinese company, this SOE, the third largest pharmaceutical company. So the key is to register it, and then once you register, of course, you will commercialize, and then this company will buy this product from RX and pay licensing fees. So that's the third catalyst. The fourth one is Zactiva. So Zactiva is actually medicinal cannabis. So it's already selling in Australia, but it is slow, because of the lockdowns. And this is prescribed by doctors. So you need to, market these products to doctors, which, with the lockdowns, you hardly can do that. So this is causing some delay and also issues with their manufacturing equipment because they actually get it from China. So they only had one apart. We were expecting 3, but they only secured 1. So for this catalyst, of course, selling in Australia but the key is to export it. So right now they have deals to export to Brazil and New Zealand. And the big one is obviously US and Europe if they can sign off on that. Our target price, we actually lowered it, but it's mainly because we cut our revenue. This stock is not about the earnings right now. It's all about the kind of the news flow, the events, especially for Wafermin. So right now we lowered it because of the slower Zactiva sales, which is this, and then the lower machine that we mentioned. Our target price is cut because they did a rights issue in July to raise money, and also because we lowered our forecast from 12 to 3 million for revenue. Okay, I'll move on to the next one, which is our Singapore Weekly. Okay, so for Singapore Weekly, just some key macro data that came up from Singapore. The first is hotel number. So this is RevPAR. It's basically revenue, your room rates times occupancy. But one easy way to kind of understand, you can just view this as revenue, the amount of revenue a typical hotel will get. So the industry is now roughly getting a RevPAR of 100. It is better than a year ago, but it is still like 50% pre-pandemic. So without stating the obvious, there's still not much recovery in hotel yet. Before that, they were enjoying maybe $200, and now it's only 100. There was a lot of URA released their third quarter stats. So these are some key highlights. We monitor this number. This is a bit unusual number here. That is the amount of transactions by HDB, resale market, new home sales and resale. We monitor this just to get a sense of the real estate agents, because real estate agent commission comes from HDB resale, private resale, and new launches. So it is still up 17%. So we should still enjoy a growth in the third quarter numbers. Bulk of it actually resale is the most vibrant right now. New is because we think there's virtually not much inventory out there. So we think the numbers will still be healthy. It will still be elevated, but the volumes will be slower. We'll show you a chart later. But in terms of new home sales, we think it's like almost a developer's market right now. We'll show you a chart later and why, but the unsold units now is 17,000. So this is the lowest number since 2017. And in terms of developers' inventory, of course, you'll be asking how you get in. So inventory is like, let's say they sell the last 12 months, a new home sale was about 12,000 units, but inventory now is 17. So you can get roughly 1.5 years of inventory if they don't replenish, buy land and whatsoever. Compared to the average is 3 years. So this is like kind of the record lows for developers in terms of the inventory they have in hand. If we move on to the US macro news, I think the main one is all about what Jerome Powell kind of commentary. So what he thinks is that he will taper. So the expectations is to taper in November, basically to slow down the purchases of bonds, of the Federal Reserve buying bonds and so forth. But he doesn't think it's time to raise rates. But I think he did mention that the inflation risk is getting quite elevated right now because of the bottlenecks and so forth. So when we look at interest rate expectations, like what is the market pricing in for 2022? The market in general is looking at least a 40 basis point, that means 0.4 percentage points increase in interest rates in general in 2022. The Fed funds, the futures market, based on the futures, like what people betting on is about 1.5 hikes, and the 10-year bond market to be at least 2.04%. Sorry, missing percent here. This is important because if this does happen, then it's obviously very positive for the banks. I think we'll elaborate later. But so technically, we still think the reopening is still intact, and I mean, we're just going to quote what the minister said. The resistance against the virus will increase progressively, either because your natural immunity, basically you got infected, or because of the vaccination. So we think, although the numbers are not good right now, the resistance will just continue to build up, at least for Singapore. The news of allowing visitors from South Asia will be positive for the construction and property sector, because it will only imply that we can get that will be the return of the foreign workers. So this is positive for construction because there's short of workers, and property mainly because of the cost and delays in delivery. In terms of the interest rate, so if you assume 40 basis point hike in interest rates, it is positive because if you look at someone like DBS, their margins is 1.4%. So if you assume a 10 or 20 basis point improvement in margins, is going to be huge, probably like 10-15% jump in earnings. And it goes straight to the bottom line because there's no cost, right? If you raise rates. And we think it is positive because even when you do raise, it is still very accommodative. You're talking from 0 to 46. So it is not too hot, not too cold. What we mean is that rates will rise, but it will not be high enough to cringe loans growth or even slow global growth. So that's why it's like a bit of a sweet spot right now if they do raise rates. It's not too aggressively tight. So that's why we still like financials from that standpoint. In terms of the events, a lot of the Facebook, Alphabet are all releasing results, like Apple, just for your reference. In terms of our webinar, next week we'll have Elite and also SPH. The big one I think probably the more popular one will be AEM, but we've yet to kind of put it into our seminar page. Yeah, sorry for jumping around. Yeah, okay. Okay, this is our usual. We look at the global cases. It's still trending down, but it seems to be flattening. The one that came out in the news, I think we were just curious to see, is the UK. So you can see the UK, the red line here, is enjoying. I mean, hopefully it doesn't go into a third wave, but this is just for everyone's reference. In Singapore, we had some flattening, but again, it's bouncing back up. I think from the newspaper, I think one of the things that they're measuring is the weekly infection rate. If it can go down below 1, basically just week on week, basically is declining. I mean, that ratio, I guess. I think I'll leave it to, these are the 3 things that they're looking for before they relax. I think it's all in the press, so I won't go through this. So we just looked at very quickly at hotels. So you can see that hotels now is 103. It's better than last year, but it's still way below the pre-pandemic. If you want to know what's happening in Changi Airport, basically there's nobody. Changi Airport is only 4% filled compared to the pre-pandemic. So there used to be 5 million, now 200,000. I think we all know this, but just to give you some numbers, that there's only 4% of, it's only 4% occupied. There's a lot of echo there, but anyway, in terms of the developers market, so this is all the transactions that we mentioned, new, resale, HDB. This is more to measure the performance of the real estate agents. So when we compare year on year, you're comparing 17,000 versus September last year, but you can see from here that it's at elevated levels. So pre-pandemic, we were probably 12,000, but because resale picked up so strongly, we're now at a new level of 16,000, 17,000. So the agents' results should still be elevated, but the growth rate will be a bit slowing down, which you can expect because pandemic 6,000, the last quarter you're comparing 15 to 6,000. So obviously the base effect, it will be like a three-fold jump. So for this one, this is the developer's inventory. So the blue line here is the unsold units, whether they have license or not. But this is just whether some are completed, some non-completed, some they have sales approval. But this is basically units that can be sold right now. So you can see the blue line here is at the lows of 17,000. And in terms of the ratio, compared to what they sold, so you can see that they used to be the high of 4-year inventory in 2019. So because of the sales doing so well, so right now it's about 1.5 compared to the average used to be almost 3 years of inventory. So right now it's 1.5 years. So we think it's like almost like a developer's market. So that's the reason why we kind of like we like CDL too, because they have the inventory now to sell, and because there's so little out there right now. Move on to the next slide. So this is just to show you an illustration of what the market is expecting for interest rates in 2022. So this is the bond yield. This is the 10-year treasuries, the longer term. So this is currently bond yields are 1.6. Expectations is actually 2%. So it's roughly 40 basis points, 0.4 percentage points. We also get something similar here. So the bars here is the number of hikes. Why is not, I was wondering too, because now it's 0, each one is 0.25. Why is it not? Because Fed funds rate is a band. So right now it's 0.08 at the effective. So this is just to show you the futures market thinks that there will be a 1.5 times hike, and then the Fed funds rate from 0.08 will go to 0.46. Roughly a 40 basis point hike, which the market is expecting for 2022. So if this happens, this will be positive for the financials of banks. Okay, this is my last slide. This is just to show you some of the results coming out this week. The one in yellow is those that we cover. I think the large ones will be Keppel Corp and Biopharma that will be releasing their results. Okay, I think that's the last one for me. Sorry, this is just for if you. This is our website. This is our Telegram chat. This is our podcast. All our reports we will do a podcast hopefully, and then this is where you can get our ListCo webinars and so forth. Yeah. Okay. Thanks everyone. Thanks for listening. I think we can go to Q&A. Vivian, I think you want to take first. There's a lot of Del Monte ones.
Okay, sure. I will first take the question on considering countries are starting to look inwards, where is Del Monte future growth? And does movement towards plant-based food help or hinder Del Monte? So firstly, for Del Monte, as mentioned, the major contributors to the revenue by geography are US and the Philippines. So these are the main growth drivers, as mentioned also in the investment merits. Firstly, for these two, for US and the Philippines, the Del Monte brand is very strong, among the top for canned products, and packaged fruits and vegetables, or maybe more known as canned foods and vegetables, have been contributing about 65% of sales on average. So this is still the main revenue contributor. And in the US, they are introducing more innovative products. So to answer the movement towards plant-based food, apart from the traditional canned foods, they actually have already introduced products that contain plant-based materials, including this veggie pocket pies and veggie bowls that provide healthy and convenient options for snacks and meal options. So that is the trend that they are also catching. So not say hindering, but maybe this would be another growth. This would be another growth driver for them. Yep. And in the Philippines, the next growth driver would be the joint venture to enter into the dairy sector. So they are, under this joint venture, they are going to distribute, or they have already started distributing. The products were, I think, launched just last week. So distribute the dairy products under 4 product lines. And this is through their wide distribution network of more than 100,000 stores in the Philippines. And there are, of course, further plans to increase this number over the next few years. So that's for the Philippines. And the last thing would be the exports of fresh and packaged pineapples under the S&W brand, but this is considered to be under Del Monte Philippines, and to markets like China, Japan, and South Korea. So with the huge market in China and S&W being the #1 imported pineapple in China, I think the growth for this could be also quite positive on this. And to maybe give a better picture, for first Q of FY22, the revenue from fresh pineapples and pineapple-related products were about 35% of total revenue from the Asia-Pacific region. Yep, so hope that helps. And I think the next question is, sorry, let me just scroll down. I think there is one on what's the time frame for the target price. So the target price is pegged to the FY22 PE ratio. Yeah, 13 times FY22 PE. I think there's one comment on comparing Del Monte with peers. Looks like it's ripe for M&A. Don't have much comment on that. I think the last one that they did was basically the US subsidiary DMFI in 2014, which they spent around, I think, 7 years to turn it around, and FY21 was the first year of profitability. Yeah, so hope that helps. The next question is why Del Monte's listing in the Philippines never go through. why want to list in the US, which takes so long? So they actually also announced that, I think for the Philippines entity, the Del Monte Philippines, DMPI, the listing was pushed back due to the COVID situation in the Philippines. And the listing of DMFI or Del Monte Foods in the US would be another possible option to kind of like deleverage the company. So that's just another possible option for Del Monte. Yep. I think the last one would be on LHN. Maybe just a few comments for LHN or to re-emphasize. So the main growth drivers would include the residential properties, which are their co-living spaces. And I think as reported in the press, the co-living trend has been quite hot as more millennials are moving out. So LHN or Koliwu has also been seeing more customers who are local young professionals. And that has increased from, I think, initially around 10% to now more than 30% of their total customers. So for LHN, they are also aggressively looking to acquire more properties for Koliwu. And we expect about 20% increase in the number of keys to begin operations for FY22. The other growth driver would be the work plus store outlets under the industrial properties. So this is mainly catering to e-commerce, people who start e-commerce businesses and need an external space to store their goods, do their work. And actually for work plus store, they also have been providing more options to improve the experience for customers. Like I think they have partnerships with delivery partners to provide delivery options and also providing car sharing services at their premises. Yeah, so I think that's all for me for now. I'll pass on the time to the rest of my colleagues first.
Viren, you want to do first? Turn on your video if you guys are answering questions. Yeah, Viren, can you, okay, but let me just go ahead first.
Hi, Paul.
Okay, you want to take control first or you go ahead?
Yes, I need to take control. Yeah, thank you. So yeah, I just want to share a screen first. So give me a moment. Yep. Okay. So yep. Okay, so anybody can see my screen, right? Yeah, just let me know if you can. You can't, just let me know. So basically I have some of the counters I have. So just give me a but due to time constraint, I'm not able to answer most of the content early on. So just want to start with the first one, the STI. By the way, I know there's a lot of UMS, but UMS, I think last week there have been some adjustment to the share price, which I'm not very sure what is happening. But so in that case, I will not be sharing the adjusted thing over today until I get the clearer picture of what happened. So first up, I go into STI. So for Straits Times Index, it has successfully reached 3,002. All right, expect that initially I expect that you have rebound going to way below 30,000, but in the end it breaks up. So right now it's testing the resistance high. Currently it's consolidating. So for the next moment, I think that we will be having a short-term kind of consolidation at the moment for that. All right, so for SDI, expect some ranging around 3181 to 3002 region. Okay, thank you. So the next one will be LHN. LHN successfully break out of the falling wedge, but I think the lack of momentum, rebounding up from the support at 30 cents, lack of momentum. So currently we are some kind of like ranging. Ichimoku is showing some sort of like ranging kind of market going on for now. All right, so that's the outlook for LHN. Nothing much that I can say for now. For Propnex has certainly grown very strong after it has broke out of the corrective falling wedge upside. So right now it's testing the resistance at 1.91. Expect some sort of like breaking up to $2 and then target a short-term target at $2.20 if that is successful. Based on the Ichimoku, we have a crossover. Right now we just need a price to break above 1.9. This 1.95 to confirm, which is confluence with the Senko Span B. All right, so if that happens, we will see a stronger confirmation of the bullish upside for the Propnex. Okay, so yeah. All right, so next one will be STAC Global. STAC downtrend is still persisting. Ichimoku is showing a downtrend. But with recent ranging after and breaking out of the falling wedge double bottom, but the double bottom is not very strong outbreak. You can see that there's like shooting star, high wave candle and a bearish candle pushing prices back below the neckline resistance at 1.08. So hence right now we are looking at, we're looking at some correction. 1.02 may seems to be a very good rebound zone going forward for STAC Global. Other than that, larger trend, still high, low, 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 high, lower, low, low, high. We are seeing a threat of a downtrend still ongoing. Okay, so even so, it just briefly breaks above the STAC Global, the primary downtrend line. All right, Wilma, I issued a report before. So there's some sort of like consolidation. So we just hope that this will be the next sub-impulse move to the upside. Just breaking above 4.46 will actually confirms the upside. And then once 4.46 is broken, we are seeing a target beyond resistance zone 1 at $4.80 going forward in this retrospect. All right. Okay, so next one will be the straight trading, higher high, higher lows. Upside is seen, but so stronger bullish momentum to the upside. Nothing much I could say for now for straight trading. Thank you. Right now we are going to Ascender Street and then followed by Thai Bev afterwards. So let me go to Thai Bev first then. So for Thai Bev, right, issued a report last week. So price actually has a consolidation at the immediate resistance zone. Strong bullish momentum upside. So Ichimoku is showing a strong three bullish golden cross. Price do they retreat, fill out the gap, but remain elevated for now above the Tenkan-sen. So if this sustained throughout the end of the trading day, then we might see a stronger back or rebound. There could be a chance that price retrace back to the origin at 0.690 before back to a rebound up again. But overall in the trend, since after it confirms the double top formation for now, a strong rebound to the upside, golden cross of the Tenkan-sen and Kijun-sen, we are confident that Thai Bev has resumed the upside and target the next resistance at 0.78 to 0.80 going forward. All right. So for the next counter will be the Ascender Street. Ascender Street has been testing the resistance over here as multiple times. You have since like these like key area of interest that we have been looking at. 1 time, 2 time, 3, 4. Ever since it breaks out of the downtrend, so we are having a range since November 2020. So the range bound has already gone for years, for close to a year right now. So any upside, we are seeing a break to, you need to confirm a break above 3.15. I mentioned like a few webinars ago, 3.15 seems like a crucial point for ascenders to actually break up to the upside. Right now we can see there's a 3-wave kind of pattern down, and then right now we are going to the upside again. So Initial part, make sure that it break above 3.09 to 3.10 resistance. Then we talk about $3.15 to be broken later on. Okay. So next one, it will be AEM. AEM, I shared in the Telegram channel before on the sustenance of the bullish rally. First up, we have some consolidation. Price remain elevated near the immediate support, which likely to be broken that time. I promoted it that 366 to 376 is likely to be a better rebound. Although my view does not change, but I feel that given the bullish upside that we've seen today and the multiple testing of the resistance zone that is seen as a weakening signal, we are seeing a stronger upside break to $4.60 before coming down of a correction back to 366 to 376 before rebound. Can see on the larger time frame, we can see that there is also a head and shoulder forming. Okay, so this will be actually a kind of like a thing that is that we are seeing going on. So that may be a reversal or potential reversal. Okay, so based on the weekly chart. All right. Okay, next one, Uma straight trading. Straight trading I've shared. So APEC reality. Okay, I won't share much about nanofilm. I mentioned a lot of time nanofilm. I have already dropped the technical coverage. First up, reason why is because it has already broken my wave count. This is the first part. Second part, it has already volume has dropped significantly once during the huge sell down, which is last time where we observe it. So right now is like ranging back towards to the bearish downside. All right. So unless there's some signal near to the current support or resistance, I won't be sharing about nanofilm. All right. So back to the APEC reality compared to PropNext which I shared earlier on. APEC although do have some sort of like a closer or a better prospect for upside, especially once it gap up. But do take note that once this gap, this opening gap, what I mean is if it closes as a like a high wave kind of candle, it may signal an island reversal and pushes price down. One thing is ascending triangle confirm to the upside. Just a bullish cross or Tenkan Sen and Kijun Sen. Some slight break above the lagging span. Just right now, Senko span A need to cross above Senko span B to confirm on the upside. But looking at the immediate downtrend line, things has been broken. This range box, which is the ascending triangle, has been broken as well. So we are looking at some sort of like a potential bullish upside. But do note that on the weekly chart, there's like a head and shoulder kind of formation as well. And also ADX on the weekly time frame can shows that it's kind of like a slowing down of trend. And then there's oversold divergence going on on the weekly chart. So back to the daily chart, yeah, so nothing much. All right, but we can see some further upside to test 0.915 to 0.940 as the MACD. I foresee there will be an upside break, and you can see that the histogram of MACD has been spiking up over. All right, so yep. So next one I'll be sharing about CapitaLand investment trust that which CICT, which Natalie has shared earlier on her presentation. So upside, is there any upside to begin with? I think there is potential, yes. How strong is it? It depends on 2.22 to 2.26 resistance level. All right, so let's take a step back. We can see that there is an ascending triangle kind of formation. Clusters of candle range bound. So anytime between 2.15 to 2.03 region is actually a sign of like a rebound. So either way, you can there's anticipation of a breakup above 2.15, or there's a price pushing down back to 2.03 to perform a strong rebound to the upside. for CICT. So for CICT, like what I shared earlier on one of the counter, Sandal Street, it has been ranging. Just that at this part, we have been ranging for a longer period of time as well, since May 2021 to October. So we have been ranging for 5 months. And I issued this report, I think, when it was start of a breakout of this descending channel. Okay, so yeah, let's look at how CICT is going to perform in the next foreseeable future. 酒店 chemical ranging part, panel field rate issued a report back in May. There's a strong bullish upside. Then after that, ranging, and then price just came down. Tested support zone once, twice, and then right now I foresee some foreseeable like ranging. Price likely is not going to go any higher more than $1.05 for the time being. Lastly, I'll share about the venture. So venture wise, I shared in the Telegram channel before. So after since there's a bullish gap up, the venture close above the Tenkan and Kijun Sen crossover. There's like a target to an immediate resistance. And then right now, I published 2 reports. Unfortunately, met with a stop loss. Is this so? Ascending triangle failed. Upside break again. Came down, touched the support zone as which I shared quite a number of times in the webinars to you guys, that this support zone 1702 and 1744 has been going straight. Falling wedge has just been broken. So likely we can see that this immediate resistance zone is likely to be broken to the upside once again. Okay, so yeah, thank you very much for your time. Let me go to Yang Zijiang for the last one before I pass my time back to my colleagues for further sharing. Okay, so for Yang Zijiang, bearish downtrend since it completed the 5-wave channel, Elliott wave, subwave. So we are likely to see the next support in the longer term at $1.08 to $1.14 going forward. All right, and then yeah, GSS one. I'm not very sure about GSS. Okay. Yeah. So Jaffa, which I will report. So Jaffa upside. Chances that you'll go back to the resistance support one at 0.810 to 0.835. Reason being, a strong momentum upside has been fulfilled of the double bottom. So once it break and confirm with two period candle up, then we can be sure that for Jaffa, bullish upside has returned for now. Okay, so right, thank you very much. So for the rest of technical, if I have time, I will just come back again and share screen. Otherwise, I will just type in the comments, and then yeah, anything just email me, and then I'll try my best to reply you over the weeks. All right. So I pass my time back to my colleague. Thank you very much.
Thanks, Viren. Let me just try to answer whatever questions are left. Although some of these we don't cover, but let me just share. So can you please share your outlook for Wilmar? There are a bit of a few moving parts. It's not so clear cut for Wilmar because there's a few moving parts. They have the consumer business, so that might be under pressure because of the higher material costs. And if you look at their China, where the China operations, the one that the company that IPO'd, the Yihai Carry Awana, right? So that stock is actually down 50% year to date. So that part might be under pressure. Their palm oil business should do well, although they may not have much contribution from the plantations. But always remember, for Wilmar, the global plantation volume will be about 70 million. They have 22, so they almost have like one third of all palm oil processed, or I guess it goes through them. So you can assume that they might probably have some informational advantage on them. So you think that they can get some good margins with the recent rising palm oil price. For their crushing could be flat because I guess the pork prices are coming down. So it's not so clear, but it should be a good set of numbers, especially for the palm oil business. Yeah. This stock also tends to trade a little bit with their Yihai Carry at the Disco in China. There was a question on UMS. I'm not sure whether was it fundamental or technical. I think it was fundamental too. So let me just share for UMS. I think the outlook is still good. If you look at their main customer, which should be Applied Materials. Now, Applied is guiding for 30% jump in revenue for fourth quarter, 60% jump in profit. So that should do well. For this is a good guide to what UMS should be performing. And the second thing is that UMS also has JEP, and JEP is involved in aerospace. So if aerospace recovers, so JEP has a good chance to. Yeah, sorry, there's someone cutting. Okay, sorry. Okay, so that is for Wilmar and UMS. So for Nanofilm, Nanofilm's major customer, I think we all know, is customer Z, which is the largest smartphone producer in the whole world. So recently, that customer announced some cutback in production. So I think that will kind of hinder Nanofilm sentiment in the near term. But do remember, Nanofilm has two parts to the business. One is the coating, which is proprietary. But that has like a blue sky scenario because the technology is proprietary and they can increase the applications from piston rings, from mobile phones and to consumer products. Can be anything because for those who don't know, so for Nanofilm, they coat products, electronic components for hardening and also for electrostatic discharge. They coat doesn't mean it's not painting or spraying. So it's this thing called vapor disposition. So it's a piece of carbon, proprietary carbon, where I think they strike it and then the ions, I'm probably pronouncing it wrongly, but the ions from it, molecules from it, will land on the component they want to coat. So they coat it at the molecule level. So in a way, and it's all proprietary process and also proprietary raw materials. The other business is probably less proprietary, but that is for sensors, for your wearables, for your watches and so forth. So they should still do well, but I think this near term a bit of loss of momentum because their main customer has probably kind of because of some supply constraints. Let me just run through the next question. China has been able to control COVID spread well thus far, but what will be the effect if they fail to do from now? Oh, of course, China is undergoing a major slowdown. I mean, if this really spreads and they lock down even more, or it will be bad for not just us, it will be bad for the whole world. In general, China global growth, that means global GDP, the growth part, I think China contributes almost 1/3 usually. So any slowdown in China is going to hurt everyone. Please share your outlook for Singtel and AEM. I think for telcos, we are getting a bit more positive on telcos like we highlighted before. If the borders reopen, they get this big jump in earnings from roaming. So telcos look better. And for Singtel, it will do well too because of India. So competition is abating, number one. And number two, there was supposed to be this big fine in India, which didn't happen and which has been delayed because they want to stress one of the competitors, Hutchinson. So near term, Singtel, I think should perform, should kind of bottom out. That's why we upgraded our call on them to accumulate. AEM, I don't cover, but I think with what's going on with Intel starting up 2 fabs, AEM should also benefit. When they come in, I think we can have better clarity when they do the webinar with us. Okay, stress trading, I don't really have much comment. Sorry for that. The rest for dairy farm, I think if dairy farm was hurt badly because there was lockdowns in Indonesia, Malaysia. All their pharmacies like Guardian, there was all in the malls in Indonesia. So if you believe the reopening is happening for Malaysia, Indonesia, and even Hong Kong because they got convenience stores, IKEA in Indonesia. So I think the outlook should also recover for dairy farm. Again, no, we don't cover this. This as good as anyone's guess of the recovery or reopening in Indonesia and Malaysia. Sorry, tech SIA, yeah, don't really. Hi Paul, do you see any? Do you see Sheng Siong as a potential beneficiary of rising inflation, as consumer is likely to be more cost conscious? I don't really see that. I'm not sure if consumer staples such a big budget of a typical, Singaporeans are just generally quite rich. So I don't think if price rise a bit, they'll probably switch from, I don't know, NTUC. I really don't know. I doubt it. I doubt it. Like we highlighted before, I mean, Sheng Siong, of course, this year won't be so good because last year you had pantry loading. But you know, they are still they're still grabbing market share, we think, and also once they can reopen HDB outlets, then I think the growth will rebound, and then probably the re-rating can come back for Sheng Siong. But in the meantime, we think it'll be more like flatline. Yeah, because the year-on-year comparison to last year when we had so much pantry loading, it's difficult comps. You still see a decline in net profit. Yeah, you know, because last year you cannot beat. Last year was incredibly, it was a huge year for Sheng Siong, as we all know. I'm not sure, Terence, you want to do this? What's the benefit for SPH for selling to Keppel? How's your view on Raffles Medical? It has dropped 7% today. I'm not sure what is the particular news, but you know, as we go to in general, Raffles Medical did well this year because a lot of government projects, government testing, government vaccination. So when we go to endemic stage, I think I'm not sure what was the news today, but in general, I don't think they can fill the gap. I mean, you go to endemic with the medical tourists. So I'm not sure why some are still so optimistic on it. But anyway. Okay, this one, yeah, thanks for the contribution. UMS had a bonus issue 144. Your views on Franklin? Yeah, sorry, we don't cover. Never actually met them, and they probably don't want to meet anyone. What is the duration of the phase 3 trial of Wafermin for IX Bio? The duration could be 2 years. The good thing about this phase 3 trial, they've already run it through with the FDA, I believe. That means because before you do it, you need to run through with FDA whether the parameters are there. So that could shorten the timeline, but it could be maybe 2 years. So in the meantime, they will just get the one off and then milestone payments. Yeah, but I guess if there is any news flow on it, that should really do well for the stock. For iFast, okay. Yeah, we were in the iFast call just now. The Hong Kong, I think the Hong Kong project that they have, it was really huge. I don't have the numbers. Glenn, do you have the PBT number in Sing dollars? They gave some guidance in their slide, but we thought the iFast, when they got the project, the MPF, the CPF equivalent project, it will be just one off, but they seem to suggest the profits, which I think 800, right? Glenn, do you have the numbers?
Give me a minute. Put it up. Yeah.
Yeah. What they are guiding for? Sorry, give me one second. What they are guiding for is a 1.2 billion revenue in 2025, 33% profit PBT margin. Yeah, so it's about 400 million Hong Kong dollars. So it's almost 70-80 million PBT for iFast, and they seem to say that this is recurrent. So the Hong Kong project is big, and when they can guide, means there's usually some upside. Right? I mean, if you're not going to give, you want to be quite conservative. You want to guide the market because it's like a profit guidance. So this thing could give them quite a huge sum. I think 70-80 million at least, just from this project alone, and it's going to be every year for the next maybe 7 years or more. Yeah, thanks. Okay, not sure anything else. Anyone else has anything to? Oh, okay, let me answer this one last one before we move on to, like, I think the CDL. What's your opinion on Hatton's? I think, right? The share price has jumped in the past week after announced it's starting to mine cryptocurrency. Is this a knee-jerk reaction or is this a viable business plan? I have really no idea. They were Malacca property developer, then now they want to mine crypto. I don't know if I really want to buy. I'd rather just buy the crypto. And not sure whether this will be a successful project. There's no details. And you know, if they had some track record, then maybe you can it could be a bit more justified. Although I think they're acquiring one company that's doing it now, but I'm not sure. If I have to take the bet, I'd rather just bet on the crypto itself. But we're going to invite them. We're trying to get them to do a webinar, so hopefully they can explain more to everyone. Natalie, you want to mention anything on CDL if you have any? Yeah. or Dasin is here. I'll hand it to you. Thanks.
Hi, sorry, wait. Let me give me a second. Okay, sorry. My virtual background seems to have disappeared, but it's okay. I'll take the question on Dasin. So for Dasin, Dasin on the 12th of October, they updated that they actually have completed the sale of 70% stake in the trustee manager to Sino-Ocean. So recall that Sino-Ocean is actually going to come in, and they also have a call to buy up a significant up to 30% of shares. So actually they are currently a shareholder. I forgot the exact number. I think they currently own about 6 to 8% of the ordinary shares or ordinary units of Dasin. So it's supposed to be like a staggered deal. So after they get a 70% stake in the trustee manager, which will give them some sort of operational control as well as deeper insight to the financials, they also have a call option to increase their stake in Dasin. So if and Sino-Ocean is an established sort of and it has affiliates to SEO, state-owned entities in China, as well as their investors are two very big insurance companies in China. Apart from that, apart from that, so we are hoping, or the market is also hoping that, you know, once the management structure has been stabilized, and, you know, once they come in as unit holders, this will of course help the. We're hoping that it will help the refinancing of the loans for Dasin, which are due to expire on the 18th of December this year. So recall that actually the loans they were up for renewal, and then they were extended. Yeah, so that has been the main concern or risk for Dasin. Yeah. So in terms of the Sino-Ocean deal and the ARA deal, which before Dasin actually announced or elected to bring in Sino-Ocean, they were actually in negotiations with ARA. Right now, the deal has progressed. The progression of the deal is way more ahead than what it was with ARA. The management has also gotten approval by the relevant authorities for this transaction. Yeah. Okay. So that's all I have to update for Dasin. Okay. For city development, so I think city development, the price has been moving up, and earlier Paul mentioned that we have that, you know, the unsold inventory for private, the unsold inventory in terms of private residential has been on the downtrend. Maybe about 16,000 remaining, 16 to 17,000 remaining, and of that, CDL actually has about 2,000 units in the pipeline to be launched. Yeah, so we can expect that we're also expecting that they'll be able to move much of these units, and are also considering that the prices in the market have been trending up. Yeah. Another thing is that for two of CDL's projects, they actually have relatively significant margins, being the Fuji Xerox redevelopment, as well as the Canning Hill Piers, the Clarke Quay redevelopment joint venture with CapitaLand. So these two assets, you know, first of all, Fuji Xerox, it has been the asset has been in CDL's portfolio for the longest time. So, you know, the land value or the asset value attached to this asset is relatively low. So that of course translates to a higher margin that can be extracted from this project. Not to mention for Canning Hill Pier, the Clarke Quay asset, the land was attained through private off-market deals. So that of course give them a significant advantage, slightly lower cost per square foot. So these two projects were actually forecasting more than 30% margin for yeah. Okay, so overall, another part of the CDL business would be the recovery of the hospitality assets. As mentioned in previous sessions, the hospitality portfolio or segment actually contributes about 15% to EBITDA. And as we know, the recovery the hospitality recovery is still slightly challenged. It's showing signs of trying to open up, but it's still a bit challenged. So with regard to that segment, fundamentally, actually, we have forecasted a slightly longer runway to recovery. We are expecting the segment to gradually improve and turn NPI positive in 2024. Yeah. Okay, so for there's also a question about CLCT. So for CLCT, they've recently done a placement, and this is because they were acquiring some logistic assets in China. And overall, for them, sorry, I've lost my mouse. Okay. Yeah, okay, so for they're still very much retail heavy. Recall that they actually did an expansion of mandate where they acquired some of the China business parks from CapitaLand. So the portfolio is currently about 19% in business parks as well as 81% in retail assets in China. And with this acquisition of logistic assets in China, I guess the story here is that they're moving towards more new economy sectors, which are of course driven by your tech, your knowledge industries, and also of course your logistics e-commerce. Yeah, and I guess that will of course provide a better diversification and income stability for CLCT. Okay, so that's about it for me. Yeah. Okay. I think there's some questions for SPH if Terence wants to take.
Yeah, sure, Natalie. So I'll take the SPH question. For us, we see, in terms of, maybe I'll read the question first, sorry. What is the benefit for SPH for selling to Keppel? So for us, we see three benefits for SPH shareholders. The first is there is certainty for SPH shareholders post-media restructuring, which has been approved at the last EGM. So the current offer by Keppel for SPH shareholders provides a support for the share price and for SPH after this media restructuring. So SPH shareholders know what is going to happen after the media restructuring, which is the offer from Keppel. SPH shareholders, if they vote to approve the acquisition by Keppel, it means that they don't need to take into account the execution risk of the company after the media restructuring. In terms of the monetization of some of the assets, they don't have to take into account the execution risk. The second benefit with the acquisition by Keppel is that they will receive a upfront realization of their NAV because the acquisition is 1x of NAV, which is a fair offer. Considering how the share price of SPH has been trading at a discount in the last for more than 5 years, traditionally property companies trade at a discount to the NAV. So the risk, in our view, we don't cover SPH by the way, but for us, the risk of not accepting the offer is an immediate downside of the SPH share price if they don't accept the offer, because you can't expect the thing to be trading at 1x NAV when property companies in general don't trade at 1x NAV. They usually trade about in terms of sector average 30% discount to the NAV. So we are looking at an immediate downside if the deal does not go through. The third benefit for SPH shareholders is that the total consideration offered by Keppel is at a 40%, about 40% upside to the undisturbed share price. So it is a very significant premium that SPH shareholders can realize. And we think, overall, we think it's a fair offer for SPH shareholders. I will move on to the next question. The next question is, will energy sector boom considering the shortage in EU and China? Yep. So we have already seen the spike in energy demand causing volatility in the energy sector. We've seen natural gas prices and crude oil prices also breaking off the low and trading at 5-year highs. The short answer is that the energy sector will benefit from the shortage that is currently in the market now, because the spike in the price will cause the spreads in the energy sector to increase, and this is then usually passed on to the end consumer. So the energy companies are benefiting from the rise in the spark spreads, and which will improve their margin. I just scroll and see if there's any more questions before I hand over. I think that's all for me. I'll hand over the time back to my colleagues.
Okay, thanks. Is there any other? I'm not sure you want to mention. Yeah, on the Okay, I'm just trying to scroll down. If you all answered, can you just mention that you've answered? Yeah. Can you share your view of IFAS after release? I think we kind of mentioned that. Can you put on the weekly summary page again? Yeah. Okay. Which part is the summary? Can someone just put back on the weekly summary page? Do you think STI can stay at 3,002 by Friday end October? Oh, this I really no idea if we can stay at 3,002. But overall, we still like we are still positive on the STI market. But you talk about end October, I really no. It's a guess, right? You guess whether the US does well, whether the FANG stocks, when they release the results, is better than expected. Yeah, probably in the very near term, the Google, Apple results probably going to lead the direction for the market. My guess in the very near term for the US, and I guess it'll affect all of us. But longer term, we like the market. We still have I think 3-4 target price for STI. It is, but it really depends on reopening. Just to give you some simple analogy, if you look at this the Singapore GDP itself, tourism is a 19 billion receipts. How they calculate, actually not particularly sure, but so tourism alone is a 5 billion, 5% of the percentage points of GDP for our economy. So if you reopen that alone can really push the growth rates and also kind of help a lot of sectors. Virtually almost every sector in the Singapore economy will do well. Obviously, because that is like you get these 5 percentage points of growth. So that's why we came out with the 3-4, and the setup for banks will also be good because firstly, banks 40% of STI, and because you got rising interest rates and a recovering economy, so the setup for banks would give the base for the STI strength for the medium term. Just by end October, I don't know. It depends how Facebook and all their results will come out. Yeah. I think the weekly summary probably the next page. Is it? I'm not sure. Oh, yeah. It's probably the Singapore weekly summary. Yeah. Okay. What is your target price for Raffles Medical and Q&M? Okay, give me a second. Where's my target? Yeah. So give me a second. The rest, is there any other questions you guys can handle before we end it? 5 minutes. Yeah, our target price for Raffles Medical is 135. Yeah. Okay. I think if there are no other, what's the outlook for Geo and Golden Energy? I don't have I need to double check on how the coal prices is doing right now. But we think coal prices still have some leg room because I don't think the mismatch in production can be easily addressed. like when we look at the numbers, remember we mentioned the power demand is growing, maybe 14, coal production is flat, and there's no growth in there's a decline in hydro. So I think the recent increase in coal production in China is probably just filling up the hydro gap. So we think the demand for coal could persist until the end of this year. Again, this is just our own view on what's happening in China. Of course, the demand from coal from Europe and all that, that's more temporary. That's a bit more fluid because that comes and goes. But no, China is the key. Without stating because China's got 4 billion coal demand a year. Okay, my target price for QNM is sorry for the delay, about 82 cents. Yeah, thanks. Okay, I think if there are no other questions, I think we can end it. Okay, yeah, I think the rest were TA questions. I think you can just send to Wei Ren for some of these TA questions. I think we'd like to thank everyone for your time. Hope to see you in some of our ListGo webinars from next week. I think we have some next week, and also hope to see you maybe the following week. So thank you everyone. Thanks for your time and all your questions. We'll give you a Phillip on the ground on IFAST because it just concluded. So we'll brief everyone on IFAST next week. So thanks everyone and take care. Have a good week ahead. Bye-bye.